All right, Brett, how are you doing, sir? It's glad to
Good.
be
Russell, how are you, man?
doing well. Doing well. It's been a while since we've been able to record something, but I'm glad we're able to get back together here right in time for the end of the year.
Absolutely, man. How's business been? You guys been busy? Wrapping up
Oh,
to wrap.
oh man, yeah, absolutely. It's I mean, look, it's a good time to be a CPA, right? There's a lot of people out there that need some help. We've got a new tax bill that came out in the middle of the year. I think now that the end of the year is coming, like people are starting to kind of feel the pressure of what does all this mean? What can I do? And then I think for a lot of businesses, they've done really well this year, right? The economy reasonably strong right now, and kind of depends on the sector there, but a lot of sectors are doing really well, and I think that they've looked at their income statement and they're starting to think, man, what I really need to talk to somebody because
Right.
the phone's been ringing, right? So it's good. That's good.
Yeah. 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 Same here. Like people are concerned that they're going to owe a lot of tax. They want to know what strategies that they can implement before year end. And that's kind of the whole point of today's podcast is like, hey, let's talk about from a business owner's perspective, what can you do to help minimize your overall tax liability? And then we'll do a second podcast where we talk about individuals on what they can do to help minimize their overall tax liability before year end. So we'll record both of these tonight so people will have a good idea. We'll probably release them simultaneously so people know exactly what they can do because we are running out of time. This is early December, and yeah, there's only a few weeks left. So if you're gonna make some moves, now's the time to do it.
Yeah, absolutely. Absolutely. It seems like every day I get a call where somebody's like, "Hey, can we do this?" And you're like, it's too late to set up that safe harbor 401k plan, right? You know what I mean? Like,
Yeah.
and they're like, "Really?" I'm like, "Yeah, like for real. It's like 3 weeks, right?" Yeah. But there's still some things out there that people can do and to be aware of. And I think that if people get on the ball and if any of these kind of strategies apply to them, they get on the ball. I think maybe they're going to be able to save some money. So that's good.
Yeah, absolutely. So let's jump into it. So I think kind of the first thing you want to do when you get close to year end, if you're having a profitable year and you're wanting to minimize your overall tax liability, first you want to try to prepay or accelerate expenses into the current year. You want to try to defer any income into the following year. So this is definitely going to be a timing difference because you're going to have to recognize the income eventually, but you're postponing it a year. So you're accelerating expenses into the current year. You're prepaying expenses. You're prepaying rent. You're prepaying software costs. Anything that's just go down your P&L and just be like, what can I go ahead and pay before year end hits? What am I going to owe next year? Typically, a bill has to be presented for you to pay it, but most businesses are happy to go ahead and take your money if you're willing to pay. Hey, if you want to prepay professional fees, you go ahead, you write me a check all day, I'll take it,
All
and
day.
we'll figure it out. It's no big deal. And then you want
Well,
to try to defer revenue, right? So
mhm.
don't check your mailbox. So they always is kind of like the comment, like, hey, just don't check your mailbox for the last few weeks of the year. And obviously most people don't pay by checks anymore, but it's kind of the same way. Like maybe slow down on sending invoices. Wait till the last few days of the year so you get paid early January. But obviously you don't want to let the tail wag the dog. You don't want to make bad business decisions and kind of put your business in a cash crunch simply for tax purposes. But, you also want to be tax conscious as well. That's kind of high level what we tell clients when we get close to year end, like, you know, defer income, accelerate expenses, and that can make a minimal amount of change, but it can certainly, move the needle a little bit.
Yeah, I would say that the first rule of tax planning is to eliminate taxes, but the second rule of tax planning is to defer taxes as long as possible, right? If you can't
Yeah.
eliminate them, then defer them as long as you possibly can. And I mean, you just never know, right? You don't know what tax laws are going to come out next year. I didn't actually think that we would have a big tax bill. I thought it was going to get kind of bogged down into Congress this year, but they got it done. You just don't know what's going to happen. So if you can defer, right, is kind of
Right.
the key there.
Yeah.
One of my for business owners, one of the things that I recommend a lot I think, 2, 3, 4 times a week, it seems like, is the solo 401k. So especially those business owners that if they're in the gig economy, if they solopreneur, that sort of thing, so you don't have any employees, that solo 401k is an amazing tax vehicle. Really allows you to defer a lot of income. There's some limitations on the percentage of income, if you're an S-Corp, percentage of salary, that sort of thing. But there are also some plan administrators out there, and you got to be careful about which administrator you use. So make sure you kind of vet this beforehand. But you go above and beyond. So you have your employee contribution of about 24,000, 25% of your income limitation for the employer side of things, right? But then some plans allow you to do what's called a mega backdoor Roth, right? So over contributing, you have to pay taxes on it, but now it's in a Roth styled account, right? So you've paid taxes on it, it's in a Roth, it grows tax free after that. But you can do that all the way up to 70 grand. So for all of the solopreneurs out there that I work with, this is a conversation we have. We usually have it earlier in the year, but the great thing about a solo 401k, other than things like safe harbor 401ks or some other vehicles, you can go ahead and set it up now. So you can get it set up in just 2 or 3 days, get it funded. So your employee contribution has to be funded by the end of the year. That's the key. And then you can do the employer contribution after that. But you
Yeah.
got to get it set up. Takes a few days. So keep that in mind, but get that employee contribution funded immediately.
Right. Love that. Yeah, I love retirement contributions, especially if you can fund money into a Roth. I mean, that's huge because grow tax deferred. Then when you take it out, it's non-taxable, which is kind of the gem that everybody's kind of looking for. As far as
Yeah.
retirement plans go. Another one that we commonly look at is for operating companies, just to make sure you're structured properly. So we have a
Yeah.
lot of people come in with, hey, I set up an LLC. I'm now making a couple $100,000 of net profit in this LLC. It's great. We don't have to file, separate tax returns, just files on our personal return, but you're paying an insane amount of self-employment tax. So easy way to minimize that is to look at the structure, go ahead and elect S corporation status that minimizes the amount of self-employment tax you pay. So with an S corporation, you're paid in two different buckets. So the first bucket is wages. You pay yourself a reasonable compensation. That wage is subject to self-employment tax, which you just pay like a normal every other employee that you're paying. So you just pay a normal wage, and there's Medicare, there's FICA taxes that come out of that, Social Security, Medicare taxes that come out of that. And the second bucket is through distributions. Those distributions are not subject to that additional self-employment tax. So you're saving 15.3% on that additional distributions that you're paying out. If you make, let's say, $100,000 of net profit, and you pay yourself a wage of $30,000, you're saving, $70,000 times 15%. So you're saving over $10,000 in tax just by simply restructuring and just making that S election, which your CPA can help you file. And if you have a profitable kind of side business or LLC that's a business that's making decent money over $50,000 of net profit, and your CPA is not recommending this, reach out to Russell or I, and let's make sure that we're working through this and that we're minimizing your overall tax liability. Because anybody that's self-employed that's making that kind of money can save significant amounts by simply restructuring, maximizing tax deductions, looking for available tax credits. I mean, there's so many things that we can do. And, we see that every day. Clients come in, you're like, oh man, you've been filing like this for years. You were
Years.
significantly overpaying in taxes. Like, let's just get started and we'll save you $20,000 this year in tax. I mean, it's not rocket science, but you do need a good CPA to kind of walk you through and make sure you're doing everything correctly. So that's a big one, is just making sure you're structured properly. And we always want to look at that at year end. We can always, make those late S elections. If you come in today, we could look at that and we could always backdate that, especially if you're already in an LLC, already have an entity formed, we can backdate that to January 1, 2025. So you have that full year of S
Right.
corporation tax savings, but we need to jump on it now to make sure that we can get that executed properly.
Yeah, yeah, for sure. And where a really good CPA comes in is you talked about, Brett, making sure that you have these right elections, making sure that you've made them timely, or if you have to do them late, that they know how to do them late, but also how all this kind of interplays together, right? So whether you're an LLC and taxed as a partnership or sole proprietor, or an S corp taxed as an LLC taxed as an S corp, how the QBI deduction comes into play and the
Right.
planning on that, especially if you're a high earning individual or high earning company, if you have a couple of owners there, and then also how some of these, like if you have if you're a sole proprietor moving to an S corp, having a conversation about what are your goals here, right? Like you want to contribute to retirement plan. Should you do a SEP or 401k? Well, a SEP's limited to 25% of your income, your wages. So if you're paying yourself less from an S corp, you may be shortchanging your ability to do that
Right.
higher retirement planning. So doing the S corp, making sure that somebody knows what they're talking about, because there's some credits available there for setting up a new 401k, even if you're a solopreneur, and and then how all of the QBI deduction plays into this too, right? So the calculation gets a little bit complicated. So thankfully, there's some software out there
Yeah.
that we don't have to do this stuff by hand, but at least having somebody who knows at a high level that these are things that they need to consider, and then doing the work to consider them, right?
Right.
I think what I see too often is that we're all busy. We're all very busy. But what happens is people go and talk to a CPA who really is just concerned about the tax return deliverable and not about kind of these conversations, right? I have a lot of CPAs that tell me that they're like, "Man, I can't believe that you're so open with your calendar and things like that." And you're like, well, it's the only way, right? To have, quick 20, 25-minute conversations with clients. And you learn a ton about what's going on in their world. And a lot of these tax planning opportunities kind of come out of there pretty quickly.
Right.
I'm always surprised that when I send out kind of year-end planning emails, how few clients respond back and want to talk, And but I promise, like especially if you have a good CPA, we're not the stereotypical, the green visor and all of that, right? We like talking to people, right? We like hanging out. So
Yeah.
so
You
reach
don't have
out.
a
Sure.
pocket protector? Where's your
I
pocket?
mean, this shirt doesn't have a pocket on it, but normally I do, but I think that's key, right? Is like reaching out. We like talking to
Yeah.
people, we like hanging out, we like learning about what's going on in your world, and if your CPA doesn't, then that's a sign that you just need to call somebody else.
Right. Absolutely. For sure.
So
What you got next?
another one here, if you're an S corp, that I think that you need to kind of think about right now is if you're an S corp, the home office deduction is one that I see get missed over and over and over again. And the problem is that it's one that what happens is that we clients want to talk about it in April, but then it's kind of too late. To take it, because if you're an S corp, you can't deduct the home office deduction the same way that you can if you're a sole proprietor, and so you have to do a reimbursement, right? And you got to actually transfer the money is the key, right? So you actually have to, especially if you're in cash basis, right? You got to transfer the money. You got to make that reimbursement. So that's one I see get missed so often. It's not a huge deduction, but some of these small deductions like this, $3,000, $4,000 deduction, could mean, $1,000, $1,500 in money back in your pocket. You stack up a few of these things, and now we're talking about real money. But that is one I see missed all the time, and it's so easy. It's so easy to do, right? Just write yourself a check, call it home office reimbursement, right? Be reasonable about it, right? So actually look at your electric bill, look at your internet bill, those kinds of things, your property insurance, property taxes, add that stuff up, take the percentage allocation there. But for a lot of people, especially property taxes where we live, is it's a really good healthy
Big
deduction that you can
expense.
take.
Yeah, absolutely. And we do that through what we on our technical term is an accountable plan where you can kind of reimburse yourself for home office, for automobile expenses that aren't run through the business, and like
Mhm.
other expenses, whether those be kind of fringe benefits through an S corporation. Yeah, that's a great one. And yeah, we're sending out calculators to our clients all the time. Like, hey, let's go ahead and get this started. Let's go ahead and calculate this amount. and then we can either run it through as a reimbursement, or if it's an LLC, that's disregarded entity, we can file that with the tax return as well.
Mm.
But yeah, that's a great one. One of the main questions that I get when it gets towards year end is like, "Hey Brett, should I get a new truck? You think like
Oh
maybe
man.
could you please tell my wife that I need to get a new truck? Like
Yeah.
maybe like an F-250, it's like a raise on it, and like maybe that Tremor edition, like a really souped up truck." And c- sometimes it helps
Yeah.
significantly, especially if you're not if you have an automobile on the business that's already been fully depreciated, it doesn't have much value remaining. Um, and you've kind of used that useful life of that automobile, and it's time for a new automobile.
Hmm.
Um, for that, we always recommend get a car that or either an SUV or a truck that qualifies for bonus depreciation. So under the One Big Beautiful Bill, they extended 100% bonus depreciation, which is awesome. Like we are stoked about this. This is
Yep.
a huge benefit for small business owners because you can write off, basically the 100% of the cost of assets that would normally need to be depreciated over a 5, 7, or 15-year life. Anything above that, you still have to depreciate over its useful life. But anything below 15 years, you can write it all off in year one,
Hmm.
including automobiles. But it has to be a qualified automobile. So there's specific rules specifically for automobiles. And you always see people like, "Hey, look at my Lamborghini on on TikTok or whatever," and they say, "Hey, it's over 6,000 pounds, so I can write this whole thing
Yeah.
off," or my G wagon or whatever. I wouldn't take advice off of TikTok. They are right that is if it's over 6,000 gross vehicular pounds, you can take it qualifies for 100% bonus depreciation. Of course, you still have to use it 100% for business, so it has to be 100% business use in order to qualify. So you still have to kind of track that and make sure that if it's used for personal and business, it has to be used at least 50% or more for business purpose in order to qualify for bonus depreciation, and it has to be over 6,000 gross vehicular pounds. Automobiles below that, you still get depreciation, you still get a big chunk of it, but it's going to be technically a luxury automobile, and it's not going to qualify for 100% bonus depreciation. So yeah, that's a big tool that we use to tell clients who are in a position where they're going to have a big tax liability and don't want to give any money to old Uncle Sam. Hey, go out and buy an automobile. Again, what I always tell clients: don't let the tail wag the dog. Don't buy stuff just to avoid taxes or to minimize your taxes. Let's make smart business decisions. If you bought a
Hmm.
new truck last year and you trade it in for a new truck this year, your tax savings is going to be minimal, and you're probably going to get upside down in that car. So don't do stuff just to think that you're going to save in taxes. Talk with your CPA. Make sure it's a good sound business decision before you pull the trigger on an automobile. But it can be a huge tax savings.
Yeah, absolutely. It's one of the best provisions of the OB3 bill that came out,
Mhm.
and is that permanent deduction, right? So that
Yeah.
they made it permanent, right? So it's yes, it's 100% depreciation, which is great. Even better is that it's permanent. So now
Right.
it's easier to plan. You don't have to be in a rush. If you don't need to buy something before the end of the year, you can wait. But what I tell clients is, look, is if you're going to buy something big in the next 3 months, 4 months, something like that, if you're already planning on doing it, just go ahead and accelerate it. Take that deduction a full 12 months earlier, right?
Right.
Because time value of money, that just increases the value of that deduction, buying it in December versus buying it in January, right? And a lot of times you can get really good deals on stuff as especially like vehicles as they're trying to close out these years, get this inventory
Yeah.
off the lot, all that stuff as they have property taxes to worry about and those kinds of things. So, dude, it's good for you. It's good for them. It's a great negotiating tool for sure.
And another little trick on that is the IRS looks at it as if for a calendar year. So
Hmm.
if you normally use your car 60% for business, 70% for business, and we're approaching year end, you can go ahead and buy an automobile now. Use it 100% for business between now and the end of the year. The
Hmm.
IRS looks at it as if that automobile was placed in service for the year. You have that full year service, it still qualifies for bonus depreciation, and you can take
Mhm.
100% if you used it 100% from the purchase date until the end of the year. You buy it on December 15th, and it it's used 100% for business for December 15th through December 31st is the time period we're analyzing. Then great, let's take 100% bonus depreciation or 90% bonus depreciation. And then the following years, if you use it as long as it's greater than 50%, it that there's no like recapture on that deduction until you sell that automobile. So, you can use it 100% or 90% in 2025. 2026, it can go back to 60 or 70%.
Mhm.
As long as it's greater than 50%, you're still fine.
Yeah, that's right. That's right. It's like the same with having kids, right? If you're gonna have a baby, make sure they're born in December, right? You get the
That's
full
right.
year deduction and only, 3 weeks of the cost or whatever it is, you know?
That's right.
Uh,
You did not want a January 1 baby.
yeah, absolutely, absolutely. Our first child was born at the end of November, and I used to tell people all the time, that was totally planned,
Right.
I
Tax
just
deduction.
absolutely. Well, I think that's a good summary there of a bunch of business deductions. Like you said, we're going to have another episode here talking about strictly individuals and what they
Yeah.
can do. I think we're going to dive into some of the cost seg studies and rental property things that people can do as well. If that's your thing, then be
Yeah.
sure and check out this next episode too.
Absolutely. That was a good one. Thanks, Russell. Appreciate
Yeah.
it.
See you soon.
See ya.